Here's what nobody tells you about being broke, and I'm not talking about the obvious stuff like not being able to afford nice things or missing out on vacations. I'm talking about the actual mathematical penalty you pay every single day just because you don't have money sitting in your account, and when you see the real numbers, it's going to make you angry because the system is literally designed to extract more money from people who can least afford it. My name is Mike, and I've spent the last decade studying how money actually works, and today I'm going to show you exactly how much extra you're paying just for being broke, and more importantly, how to stop paying it. If this is your first time here, hit that subscribe button and smash the like, because I guarantee you nobody else is going to explain this to you the way I'm about to. Let me start with a scenario that probably sounds familiar. You're at the gas station and your tank is almost empty, but you've only got $23 in your checking account until payday. So instead of filling up the tank, which would cost $40, you put in $15, which gets you through the next few days, but means you're going to make 3 separate trips to the gas station this week instead of 1. Now here's the thing that most people miss. You just paid a premium for being broke because you drove out of your way multiple times, burned extra gas getting to the station, and wasted probably 45 minutes total that you could have spent doing literally anything else. But the real kicker is this: that gas station you stopped at 3 times charges 12 cents more per gallon than the Costco that's 15 minutes away. Except you can't shop at Costco because you don't have the $60 annual membership. And even if you did, you can't afford to buy the bulk quantities that make it worth shopping there in the first place. This is what I call the broke tax, and it's not just gas, it's everything. Let me show you what I mean with actual numbers, because when you map this out, it's absolutely insane how much extra money flows out of your account just because you don't have enough money to begin with. Let's take 2 people. We'll call them James and Marcus. They both make $75,000 a year. They both live in the same city. They both have similar expenses. But here's the difference. James has $8,000 sitting in his savings account. Marcus has $400. Now watch what happens over the next 12 months. Marcus pays a monthly fee of $12 for his checking account because he can't maintain the $1,500 minimum balance. That's $144 a year. James pays $0 because he keeps enough in his account to waive the fee. Marcus bounced a check last month because his paycheck deposited a day late and his rent payment went through early. That's a $35 overdraft fee. This happens to him maybe 3 times a year, so that's another $105. James never pays overdraft fees because he's got buffer money. Marcus is paying $179 a year for car insurance. James is paying $132 for the exact same coverage. Why? Because James paid the full 6 months up front and got the discount. Marcus pays month to month because he can't afford the lump sum. That's $564 versus $792 annually, a difference of $228. Marcus needed new tires last month. He couldn't afford to pay cash, so he put them on a credit card at 18% interest. The tires cost $600, and it's going to take him 8 months to pay off, which means he's paying an extra $65 in interest. James paid cash, 0 interest. Marcus rents his modem from his internet provider for $15 a month because buying one outright for $120 felt like too much money at the time. That's $180 a year. James bought the modem 3 years ago. It's paid for itself 4 times over by now. Marcus uses a check cashing service twice a month when he needs cash immediately and can't wait for his bank's processing time. That's $5 per transaction, another $120 per year. James just uses his bank's ATM. 0 fees. Are you starting to see the pattern here? We're not even halfway through the list. Marcus needed to borrow $300 from a payday lender when his car needed an emergency repair. The 2-week loan cost him $45 in fees. He's done this twice this year. That's $90. James used his savings, paid 0. Marcus keeps missing the early payment discount on his utility bills because his paycheck doesn't hit until after the due date. That's costing him about $8 a month, another $96 annually. James pays early every month, saves the discount. Marcus bought a used car 2 years ago. He needed financing. His credit score was okay, but not great because he's missed a few payments when money was tight. His interest rate is 9.5%. James got 6.2% on the exact same year and model, on a $20,000 loan over 5 years. Marcus pays about $3,300 more in interest than James. Let me add this up for you. Banking fees, $144. Overdraft fees, $105. Higher car insurance from monthly payments, $228. Credit card interest on necessary purchases, $65. Modem rental, $180. Check cashing fees, $120. Payday loan fees, $90. Missed utility discounts, $96. And we haven't even counted the biggest one yet. Higher auto loan interest rate, that's $3,300 over the life of the loan, or about $660 per year. Adding all of that up, Marcus is paying roughly $1,700 more per year than James. And remember, they make the same salary. They have similar lifestyles. The only difference is that James had money in the bank and Marcus didn't. But wait, it gets worse, because we haven't talked about opportunity cost yet. This is where the broke tax really starts to compound in devastating ways. Marcus can't take advantage of sales because he doesn't have the cash on hand. James sees that his favorite protein powder is 40% off if you buy 3 containers. He stocks up and saves $160 over the next 6 months. Marcus has to buy 1 container at a time. At full price, Marcus can't afford the annual Amazon Prime membership at $140, so he pays for shipping on individual orders throughout the year. That's probably another $80. James gets free 2-day shipping on everything. Marcus needed a suit for a job interview. He had to rent one for $80 because he couldn't afford to buy one. James bought a quality suit on sale 3 years ago for $300. He's worn it to 15 interviews and events since then. The per-use cost is basically nothing at this point. Here's one that really gets me. Marcus uses a tax preparation service that charges him $220 because he doesn't have time to figure it out himself, and he can't afford a real accountant. James pays an accountant $350 who finds him an extra $1,200 in deductions that Marcus's tax prep service completely missed. So James spent $130 more but netted $850 more. In his refund, Marcus is losing money by trying to save money, and this happens all the time. Now let's talk about the big one that nobody wants to acknowledge: missed investment returns. James takes $200 from every paycheck and puts it into a Roth IRA. That's $400 a month, $4,800 a year, over 30 years at an average 7% return that grows to about $450,000. Marcus can't afford to invest anything because he's paying $1,700 a year in broke tax, plus he's always catching up from the last emergency. So at the end of 30 years, James has built nearly $500,000 in retirement savings. Marcus has zero. The opportunity cost of being broke isn't just the fees you pay today, it's the compound growth you miss out on forever. Let me show you another angle on this, because it's not just about fees and missed opportunities. It's about the actual price you pay for goods and services. Rich people get discounts that poor people can't access, and I'm going to prove it with math. Costco sells a pack of 36 rolls of toilet paper for $28. That's about 78 cents per roll. The convenience store down the street sells a 4-pack for $6. That's $1.50 per roll. You're paying 92% more per roll just because you can't afford to buy in bulk or can't afford the membership to shop at the warehouse store. Chicken breast at Costco is $4.99 per pound. At the regular grocery store, it's $8.99 per pound. You're paying 80% more for the same chicken. This same pattern shows up everywhere. Laundry detergent costs 43% more when you buy the small bottle instead of the bulk size. Garbage bags cost 68% more per bag when you buy the small box. Paper towels cost 55% more per sheet when you can't afford the mega pack. I could keep going, but you get the point. Being broke makes everything more expensive, and the cruel irony is that the people who can least afford these markups are the ones forced to pay them. Now let's talk about housing, because this is where the broke tax reaches absolutely insane levels. Marcus rents a 1-bedroom apartment for $1,800 a month. He's been there for 4 years. That's $86,000 he's paid with zero equity to show for it. James bought a small condo 4 years ago. His mortgage payment is $1,700 a month. But here's what happened. His property appreciated in value by $60,000. He's built up about $48,000 in equity through his payments, and he's getting a tax deduction on his mortgage interest of about $4,000 a year. So, while Marcus spent $86,000 and has nothing, James spent about $82,000, but has $108,000 in equity and appreciation, plus $16,000 in tax savings. The net difference is over $120,000 in just 4 years. You might be thinking, well, obviously buying is better than renting, but that's not my point. My point is that Marcus couldn't buy because he didn't have the down payment. He didn't have the down payment because he was paying $1,700 a year in broke tax, which prevented him from saving, which kept him renting, which cost him $120,000 in 4 years. This is the trap. Being broke costs money, which keeps you broke, which costs you more money. It's a cycle that's almost impossible to break without understanding exactly what's happening. Let me give you one more example that's going to blow your mind. Credit scores. Marcus has a credit score of 650, not terrible, but not great. James has a score of 760. When they both applied for a mortgage on a $300,000 house, Marcus got quoted 5.8% interest. James got 4.1% over 30 years. Marcus will pay $278,000 in interest. James will pay $198,000 in interest. That's an $80,000 difference on the exact same house, just because Marcus's credit score was lower. And why was his credit score lower? Because he's been paying the broke tax for years, which caused him to miss a few payments here and there, which dinged his credit, which now costs him $80,000 over the life of his mortgage. Here's what makes this even more infuriating. The system is specifically designed this way. Banks charge poor people more because they're considered higher risk, but they're only higher risk because they don't have money, which they don't have, partially because the banks are charging them more. Insurance companies do the same thing. They charge people with lower credit scores more for car insurance, even though your credit score has nothing to do with how well you drive. They've just found a correlation between low credit scores and filing claims, so they use it as an excuse to charge more, which makes it even harder for those people to build savings, which keeps their credit score low, which keeps their insurance expensive. Let me break down what it actually takes to escape this cycle, because that's the whole point of this video. Understanding the problem is step 1, but you need a strategy to break free, and that strategy has nothing to do with cutting out your morning coffee or canceling Netflix. Those are band-aids on a bullet wound. The real strategy requires you to think in systems, not sacrifices. Here's what I mean. The broke tax is a system of compounding penalties. The only way to beat a system is with another system, a system of compounding advantages. Step 1 is to build a buffer, and I don't mean save for 6 months of expenses. I mean save enough money to avoid the expensive penalties we just talked about. For most people, that number is somewhere between $2,000 and $3,000. That's enough to keep your checking account above the minimum balance. That's enough to pay your car insurance 6 months at a time and get the discount. That's enough to buy the bulk pack of toilet paper at Costco. That's enough to avoid overdraft fees and payday loans and check cashing services. Once you have this buffer, you're immediately saving that $1,700 a year in broke tax, which means you can now save $1,700 a year that you couldn't save before. That's $140 a month. Now take that $140 and keep building your buffer until you have $6,000. This is your opportunity fund. The opportunity fund is different from an emergency fund. An emergency fund is for when your car breaks down. An opportunity fund is for when you see a deal too good to pass up. Maybe your grocery store has a massive sale on non-perishable items. Maybe you find a certified used car that's priced $2,000 below market because the dealer needs to move inventory. Maybe there's a professional certification course that costs $800, but could increase your salary by $10,000 a year. The Opportunity Fund lets you take advantage of these situations. And here's the beautiful part. Once you start capturing opportunities instead of just avoiding penalties, your financial situation accelerates exponentially. Step 2 is to ruthlessly eliminate recurring fees. I'm talking about every single subscription, every monthly charge, every automatic payment. Go through your bank statement from the last 3 months and highlight every recurring charge. You're going to find stuff you forgot about. You're going to find services you don't use. You're going to find expensive options you could replace with cheaper alternatives. That modem rental for $15 a month. Buy it for $120. You'll break even in 8 months and then save $180 every year forever. That gym membership you haven't used in 6 months. Cancel it and do bodyweight workouts at home until you're actually committed to going. That subscription box that costs $30 a month. You don't need it. I don't care how much joy it brings you. You're trying to escape the broke tax. You can resubscribe later when you're wealthy. Step 3 is to fix your credit score, because as we just saw, your credit score determines how much you pay for almost everything, and the good news is that fixing your credit isn't complicated. It just takes time and consistency. Set up automatic payments for all your bills so you never miss a due date. Pay down your credit card balances below 30% of your limit. Don't close old credit cards, even if you're not using them. Because length of credit history matters, dispute any errors on your credit report, and there almost always are errors. Within 12 to 18 months, you can typically boost your score by 50 to 100 points, and every 20 points you gain saves you thousands of dollars on your next car loan or mortgage. Step 4 is to increase your income, and before you roll your eyes, hear me out. I'm not talking about vague advice like start a side hustle. I'm talking about specific tactical moves. If you're making $75,000 a year, a 10% raise is $7,500. That's $625 per month. That's more than enough to break the cycle we've been talking about. How do you get a 10% raise? You document everything you do that makes your company money or saves your company money. You build a case with numbers and you ask for it. If they say no, you start interviewing at other companies. Job hopping is the fastest way to increase your income in today's market. Staying at the same company for 5 years is actually costing you money because annual raises rarely keep up with what you could get by switching jobs. Alternatively, you could add income streams, and I don't mean drive for Uber, I mean leverage skills you already have. If you're good at Excel, you could consult for small businesses that need help organizing their data. If you know graphic design, you could pick up freelance projects. If you're a good writer, there are companies that pay decent money for content. The goal isn't to work yourself to death. The goal is to add an extra $500 to $1,000 per month that goes straight into breaking the broke tax cycle. Once you've built your buffer and optimized your expenses, you can drop the extra income, or you can keep it and accelerate your wealth building. That's up to you. Here's something crucial that most personal finance advice completely misses. Escaping the broke tax isn't about being frugal, it's about being strategic. Frugal people focus on spending less. Strategic people focus on keeping more. There's a massive difference. Frugal is clipping coupons to save $2 on cereal. Strategic is buying a year's worth of cereal when it's on sale for 40% off. Frugal is driving across town to save 5 cents per gallon on gas. Strategic is buying a fuel-efficient car that saves you $100 a month in gas costs. Frugal is skipping lunch to save $8. Strategic is meal prepping on Sundays, so you spend $30 on groceries instead of $160 on takeout throughout the week. Frugality is about sacrifice. Strategy is about systems. Let me show you what happens when someone actually implements this system. Let's go back to Marcus. Let's say Marcus watches this video and decides to break the cycle. Month 1, he cuts 3 subscriptions he doesn't use, saves $45. He switches to a no-fee checking account, saves $12 a month. He sets up automatic bill pay to avoid late fees and overdrafts. That's another $12 a month in avoided fees. Total monthly savings, $69. He puts all of that into a separate savings account. Month 2, he does the same thing. Now he's got $138 saved. Not life-changing, but it's a start. Month 6, he's got $414. Still not much, but now he can avoid the payday lender next time his car needs a repair. Month 12, he's got $828. Plus he picked up some freelance work that added an extra $300 a month for a few months. Now he's sitting on about $2,000. This is where things get interesting. Marcus uses $120 to buy his own modem. He uses $600 to pay his car insurance for 6 months and gets the discount. He still has $1,200 left in his buffer. Now he's saving the broke tax every single month. That's $140 a month. He wasn't saving before. Year 2, he focuses on building his opportunity fund while continuing to avoid the broke tax. By the end of year 2, he's got $6,500 saved. His credit score has jumped from 650 to 710 because he hasn't missed a payment in 18 months. He refinances his car loan and saves $63 a month in interest. Year 3. Marcus has $11,000 saved. He uses $2,500 as a down payment on a certification program that increases his salary from $75,000 to $87,000. Now he's making an extra $1,000 a month. He could lifestyle inflate and spend it all, but he doesn't because he's broken the identity of being broke. By year 5, Marcus has $48,000 in savings and investments. He's paid $0 in broke tax for 4 years straight. That's $6,800 he didn't light on fire. His credit score is 760. When he buys a house, he gets the same interest rate as James. He's completely transformed his financial trajectory. And here's the kicker. His income only increased by $12,000 over 5 years. That's not a lottery win. That's one decent promotion or job switch. The real difference wasn't how much he made, it was how much he kept and how strategically he deployed it. Now I want to address something that's probably going through your head right now. You're thinking, this sounds great, but it's too hard when you're actually broke. And you're right, it is hard. I'm not going to stand here and tell you that escaping the broke tax is easy. It's not. It requires discipline when you're exhausted. It requires saying no to things you want when everyone around you is saying yes. It requires thinking 6 months ahead when you can barely think 6 days ahead. But here's what I need you to understand. Staying broke is also hard. In fact, staying broke is way harder than escaping, because staying broke means paying that $1,700 broke tax every single year for the rest of your life. It means never being able to take advantage of opportunities. It means working until you're 70 because you couldn't invest in your 30s. It means one emergency away from financial catastrophe for decades. That's hard. So yes, escaping requires short-term difficulty, but staying trapped requires lifetime difficulty. You get to choose which hard you want, and here's some motivation. The broke tax isn't going away. In fact, it's getting worse. Banks are charging more fees. Insurance companies are finding more reasons to charge poor people extra. Bulk buying is becoming more advantageous as prices rise. The gap between what broke people pay and what wealthy people pay is widening every single year. If you don't break the cycle now, it's going to be even harder in 5 years. The time to start is today, not Monday, not next month, not after you get your tax refund. Today. Here's your action plan. Tonight, when you get home, you're going to pull up your bank statements from the last 3 months. You're going to highlight every fee, every interest charge, every subscription, every recurring payment. You're going to add them all up. That number is your broke tax. That's how much extra you're paying just for not having money. Then you're going to open a separate savings account at an online bank that pays actual interest. You're going to set up an automatic transfer of whatever you can afford. Even if it's just $25 per week, that's $1,300 a year. That's a start. Then you're going to look at your biggest broke tax expenses. Maybe it's overdraft fees. Maybe it's paying rent on a modem. Maybe it's month-to-month car insurance. Pick the top 3 and make a plan to eliminate them within 90 days. Finally, you're going to commit to not taking on any new recurring expenses for the next year. No new subscriptions, no payment plans, no rent-to-own garbage. You're going to pause the outflow so you can finally start building the buffer that breaks the cycle. This isn't sexy advice. I'm not promising you'll be a millionaire in 6 months, but I am promising that if you follow this system for 2 years, you'll save thousands of dollars in broke tax. You'll build a buffer that changes how you sleep at night, and you'll start capturing opportunities instead of just avoiding disasters. That's the difference between staying trapped and building actual wealth. The broke tax is real, it's expensive, and it's designed to keep you exactly where you are, but now you know how it works, and more importantly, you know how to beat it. If this video helped you see money differently, hit that like button and subscribe, because I'm going to keep breaking down the financial systems that nobody else wants to explain. Drop a comment and let me know what your biggest broke tax expense is. I read every single one, and I'll see you in the next video.